Let's talk about the biggest lie Wall Street ever sold you. The lie that you need thousands of dollars, a guy in a suit, and a summer home in the Hamptons just to start investing. It is completely false. In fact, if you have $100 right now, you have everything you need to start building generational wealth. Today, we are going to tear down the gatekeepers. We are going deep into exactly how you can start investing with just $100. We are going to look at the math, the psychology, the exact platforms, the specific assets, and the step-by-step blueprint to turn that single Ben Franklin into a snowball of wealth. This isn't a get-rich-quick scheme. This is a get-rich-quick straight-edge strategy. It requires patience, discipline, and a fundamental understanding of how money works. So, let's dive into the absolute reality of investing your first $100. Phase 1. The mindset and the math. Before you put a single dollar into the market, you have to understand what investing actually is. Investing is not gambling. It is not guessing which meme stock is going to rocket to the moon tomorrow. Investing is the process of putting your money into assets that have a historical probability of increasing in value over time, while simultaneously generating cash flow. When you hold your $100 in cash, it feels safe, but it is actually guaranteed to lose value. Why? Inflation. In America, historical inflation hovers around 3%, though we've recently seen it spike much higher. If inflation is 3%, your $100 loses 3% of its purchasing power every single year. Holding cash under your mattress is a guaranteed negative return. Investing is how you outpace inflation and protect your purchasing power. The secret ingredient here is compound interest. Compound interest is simply earning interest on your interest. If you invest $100 and earn a 10% return, you make $10. The next year, you are earning 10% not on your original $100, but on $110. It seems small at first, but over decades, this mathematical phenomenon creates millionaires. If you take that initial $100 and you commit to adding just another $100 every single month, invested in the broad stock market, returning an average of 8 to 10% annually, in 30 years, you will have over $150,000. The vast majority of that money won't even be money you put in. It will be the growth generated by compounding. Phase 2. The foundation, high yield, savings, and debt. You shouldn't put your $100 into the stock market if your financial house is on fire. First, look at your debt. If you have credit card debt with a 24% interest rate, there is no investment that pays you 24%. Paying off high-interest debt is the absolute best return on investment you can get, because it is a guaranteed return. If you have bad debt, your first investment is wiping it out. Second, you need an emergency fund. What happens if your car breaks down or you lose your job? If your only money is tied up in the stock market, and the market happens to be down that month, you will be forced to sell your investments at a loss just to pay rent. That is how people lose money in the stock market. Before you buy stocks, you need a cash buffer. But do not put this in a traditional brick-and-mortar bank checking account that pays you 0.01% interest. You need to open a high-yield savings account, or HISE. Platforms like Ally Bank, Marcus, Discover, or Capital One 360 offer these accounts. They pay significantly higher interest rates, often around 4 to 5%, depending on the federal funds rate. These accounts are FDIC insured up to $250,000, meaning the United States government guarantees your money is safe. If you only have $100 and no emergency fund, your first move is opening an HYSA and parking that money there. It is zero risk, and it gets you in the habit of earning a yield on your cash. Phase 3. The stock market and fractional shares. Assuming you have no bad debt and a small cash buffer, you are ready. Decades ago, $100 wouldn't get you far because you had to buy whole shares of stock. If a single share of Amazon cost $3,000 and you only had $100, you were locked out. Today, the landscape has completely shifted in favor of the retail investor. We have zero-commission trading and fractional shares. Fractional shares allow you to buy a slice of a single share of stock based on a dollar amount. You don't buy one share of Apple, you buy $100 worth. If Apple is trading at $200, your $100 buys you half a share. If Apple pays a dividend, you get half of that dividend. You get the exact same percentage return as the billionaires. Where should you open this account? Fidelity Investments is arguably the best all-around brokerage for beginners in the U.S. They offer fractional shares, zero-commission trades, zero minimum balances, and excellent customer service. Charles Schwab is another legacy institution that offers exceptional research tools and reliability through Schwab Slices. If you want an app-first experience, Robinhood and Webull are popular. They have beautiful interfaces that make investing easy. However, you must be careful. These apps are designed to be slightly gamified, which can tempt you into trading too often. Remember, we are investing for the long term, not day trading. Phase 4. What to actually buy. The power of index funds and ETFs. So, you have your $100 sitting in your Fidelity or Robinhood account. What do you click buy on? The biggest mistake beginners make is trying to pick individual winning stocks. Picking individual stocks is incredibly difficult. Even professional Wall Street fund managers, people who get paid millions of dollars to analyze companies all day, fail to beat the market average. Over a 10-year period, if the pros can't do it, neither can we. Instead of trying to find the needle in the haystack, we are going to buy the entire haystack. This is done through an ETF. An ETF is essentially a basket of hundreds or thousands of different stocks bundled together into one single ticker symbol. When you buy one share of an ETF, you instantly own a tiny piece of every single company inside that basket. It provides instant diversification, reducing your risk dramatically. The gold standard for beginner investors is an S&P 500 ETF. The S&P 500 tracks the 500 largest, publicly traded companies. We are talking about Apple, Microsoft, Google, Amazon, Berkshire Hathaway, Johnson & Johnson, and Visa. By putting your $100 into an S&P 500 ETF, you are betting on the entire American economy. Historically, it returns about 10% per year. The three most popular S&P 500 ETFs are VOO, IVV, and SPY. They all do the exact same thing. VOO is highly recommended because it has an incredibly low expense ratio. This is the annual fee the fund manager charges you. If you invest $10,000, they only charge you $3 a year to manage it. It is practically free. If you want to go even broader, you can buy a total stock market ETF like VTI, which tracks over 3,000 companies. With your $100, the smartest move is to log into your brokerage. Search for VU or VTI, select Buy in Dollars, and execute the trade. You are now a part owner of the greatest wealth-generating machine in human history. Phase 5. Automated investing through robo-advisors. What if you don't even want to log into an app or search for ticker symbols? What if you want to completely put your money on autopilot? This is where robo-advisors come in. Robo-advisors are automated investing platforms. When you sign up, they ask you a series of questions about your age and income. What is your risk tolerance? What are your goals? Based on your answers, their algorithm builds a fully diversified portfolio of ETFs. Betterment and Wealthfront are the two heavyweights in this space. You can start with extremely low minimums, easily covering your first $100. You link your checking account, and the robo-advisor takes care of the rest. They automatically invest your money and reinvest your dividends. Rebalancing is crucial. If stocks go up a lot, your portfolio might become too risky. The robo-advisor automatically rebalances your portfolio. Wealthfront also offers tax loss harvesting, an advanced strategy where they sell assets that lost value to lower your tax bill. The downside? Robo-advisors charge a management fee, usually around 0.25% annually. On $10,000, you pay $25. It's a small price for complete automation and peace of mind, making it a fantastic place for your first $100. Another popular option is Acorns, famous for roundups. You link your card, and when you buy coffee, Acorns rounds it up. It makes investing completely invisible. You can let the roundups build your wealth effortlessly over time. Be aware of Acorns' flat monthly fee. If your balance is very small, a $3 monthly fee eats into your returns. Phase 6. Tax-advantaged accounts, the Roth IRA. We need to talk about taxes because it doesn't matter how much money you make, it matters how much money you keep. If you open a standard brokerage account on Fidelity or Robinhood, you have to pay taxes on your profits. If you buy a stock for $100 and sell it a year later for $200, the IRS is going to take a cut of that profit. But the U.S. government actually wants you to save for your own retirement. So they created special accounts that offer massive tax loopholes. The most powerful tool for a beginner investor is the Roth IRA, or individual retirement account. Here is how a Roth IRA works. You put money into the account that has already been taxed from your paycheck. You use that money to buy investments like your VOO index fund. That money grows completely tax-free. When you turn 59.5 years old, you can withdraw all the money and all the profits without paying a single dime. Imagine you invest diligently and your account grows to $1 million over your lifetime. If that was in a regular account, you could owe hundreds of thousands of dollars in taxes when you withdraw it. In a Roth IRA, you keep every single penny. 'Tis legal tax evasion endorsed by the IRS. Every major brokerage, Fidelity, Schwab, Vanguard, allows you to open a Roth IRA for free. If you are investing your $100 for long-term retirement, you should not be using a standard taxable account. You should be opening a Roth IRA, depositing your $100 there, and then buying your ETFs inside that tax-sheltered account. Phase 7. Alternative investments, real estate, and beyond. Let's step outside the stock market. Historically, real estate is one of the greatest wealth-building assets, but you can't buy a house with $100, or can you? Welcome to the world of crowdfunding and micro-real estate. Platforms like Fundrise allow everyday people to invest in commercial real estate, apartment complexes, and single-family rental developments with as little as $10. Fundrise pools the money of hundreds of thousands of investors to buy large-scale real estate projects. In return, you get a share of the rental income generated by the properties, as well as a share of the appreciation. Your returns are paid out as quarterly dividends, which you can automatically reinvest to buy more shares. This is a phenomenal way to take your $100 and gain exposure to the real estate market without ever having to deal with broken toilets, bad tenants, or taking out a massive mortgage. It diversifies your money away from the stock market. However, remember that platforms like Fundrise are highly illiquid. Unlike a stock that you can sell in 1 second, money tied up in private real estate is locked in for years. Only put your $100 here if you don't need it for 5 years. And then there is cryptocurrency. We cannot talk about modern investing without addressing Bitcoin and Ethereum. Crypto is highly volatile, highly speculative, and largely unregulated. It goes through massive boom and bust cycles. However, because the upside potential is incredibly high, advisors suggest allocating a very small percentage of your overall portfolio, around 1 to 5%, to blue-chip cryptocurrencies like Bitcoin. You can easily do this with your $100. Platforms like Coinbase or Kraken allow you to buy fractional amounts of Bitcoin. You don't need $60,000 for a whole Bitcoin. Your $100 will buy you a fraction of a coin, known as Satoshis. If you choose to go this route, treat it as highly speculative. Assume that $100 could drop to $20 tomorrow, and only invest it if you are willing to hold on for the long ride. Phase 8. The greatest ROI investing in yourself. we have talked about stocks, real estate, and crypto. But mathematically, none of these will give you a higher percentage return on a $100 investment than investing in your own earning potential. The harsh reality is that you cannot cost-cut your way to massive wealth. You can only save so much money, but your ability to earn money is virtually limitless. If you take that $100 and use it to acquire a new skill, that skill can increase your salary by thousands of dollars a year. That is an infinite return on investment. How do you do this? First, books. For $100, you can buy 5 or 6 of the most profound financial books ever written. The Psychology of Money by Morgan Housel will completely rewire how you view wealth. Atomic Habits by James Clear will teach you how to build the daily systems required to succeed. The Simple Path to Wealth by J.L. Collins will give you the ultimate blueprint for stock market investing. The knowledge in these books is worth millions, and you can buy them for $20 each. Second, online courses. Platforms like Udemy or Coursera offer massive discounts where courses cost $15 to $20. You can learn how to code in Python, master Excel, do digital marketing, or how to edit videos. You learn video editing for $20 and use that skill to pick up a freelance gig that pays you $500 a month. Your initial investment has paid for itself 100 times over. When you only have a small amount of capital, your biggest asset is your mind and your time. Upskilling yourself is the ultimate cheat code to generating more cash flow, which you can then pump into the stock market. The ultimate $100 action plan. We've covered the entire landscape. Deep research, multiple platforms, zero excuses. Now, let's distill this down into a concrete, definitive action plan for your exact $100 today. Step 1. The debt and buffer check. Do you have a credit card balance charging you 20%? If yes, log into your banking app right now and put the $100 toward that balance. That was a guaranteed 20% return. Step 2. If debt-free, secure the emergency fund. Do you have absolutely zero cash to your name? Take the $100, go to Ally or Marcus, open a high-yield savings account, and deposit the money. Let it sit there and earn 4 to 5% risk-free. Step 3. If your basics are covered, enter the market. You have no bad debt and a small cash buffer. Now we build wealth. Go to Fidelity, open a Roth IRA account. Link your bank account and transfer the $100. Once the funds clear, search for the ticker symbol VOO. Select Buy. Choose dollars, type in $100, and hit Submit. You have just bought fractional shares of the 500 most powerful companies in America inside a tax-free retirement account. The hardest part about investing isn't the research. It's overcoming the inertia to start. That first $100 breaks the psychological barrier. It shifts your identity from a consumer to an owner. Once you see that first dividend hit your account, even if it's just a few cents, something clicks in your brain. You realize the system is real, the math works, and wealth is accessible to you.